Inflation is skyrocketing, and for all we know, it could hit 20% maybe this year or next year. And usually, the best hedge against inflation is investing in metals. Primarily, is gold. Gold, usually, throughout the centuries, has been the best investment to hedge against inflation. But of course, data shows something else. So in this chart, I show you the inflation on the top portion in green and gold in orange in the bottom half. And the data here is since the 60s, and the gold is plotted in US dollars. And as you can see, it was flat here, and then in 71, when the dollar unhinged from the attachment with the gold, then of course started its run. Now, gold since 1970 achieved about 7.5 compound annual growth rate. The problem though is this: you can see that since 1980 we made a peak, and we didn't get out of that peak until somewhere in 2008. So that's 28 years of gold doing nothing. And then again in 2011 till today in 2022, gold didn't do anything also. So if you invested in 2011, so far you are almost break even, and same thing happened here for 28 years. Now, of course, this is not good because, first of all, 28 years is a really long time. So definitely buy and hold strategy in gold should be dropped because, as you can see, it's not a good strategy. So this is the correlation between gold and inflation. And this correlation is over 1 year. Correlation goes up from -1, which is negatively correlated, all the way to +1, which is positively correlated. Positive correlations mean if the inflation rises, then we expect gold to rise. So that is the theory, that we should invest in gold when inflation goes up, meaning we are looking for a positive correlation, hopefully at 1 all the time. But of course, the data shows otherwise. And if we zoom in a little bit here, we can see that the correlation goes from negative to positive, and sometimes it stays in the middle, meaning there is no correlation. But I want to bring your attention to the huge bull market in gold that happened since the year 2000. Since the year 2000, gold, it was always up almost. And again, we can see that in this bull market, correlation was not stable. So it went positive, negative, positive. It's almost all the time. So we cannot take this statement and use it in our investment decision, meaning we cannot invest in gold every time the inflation goes up, because just like we saw in the data, the correlation is not there. Sometimes it's up, sometimes they're positive, sometimes they are negative. So we cannot use that. And buy and hold, again, it's really crappy strategy. In fact, it's a crappy strategy for everything because I showed on this channel many times that you can beat buy and hold by a lot, either by reducing the drawdown or making money, more money, or both. But still, we can include gold in different strategy. So let's start with tactical asset allocation portfolios, because those are the easiest and they should include some percentage in gold. So here is a long list of tactical asset allocation strategies, and here I show you the matrix for these strategies. So this shows the strategy and then what asset they hold, and you can see gold is in the most strategies, let's say, and of course because it plays a big role. So for example, this is Aspect Partners Risk Managed Momentum. By the way, these strategies are all highly documented. They have white papers behind them, so this is not optimized strategies. Most of them have been developed long time ago. So this is the data since 1970, and you can see the strategy is making 15% compound annual growth rate with 20% maximum drawdown, and this strategy holds gold on average 2.8%. Ray Dalio's all-weather portfolio, it's always have a fixed percentage, 7.5% in gold, and the performance is 8.9% since 1970. Composite dual momentum, this one made 11.5% since 1973, and the gold percentage is 9.6 on average historical allocation. And finally, I'm going to show you this one. This is Ned Davis three-way model. This also made 11.2% a year, and this one holds 27.4% in gold on average historically. Now, also, I want to show you that in my Discord server, the global asset momentum portfolio sometimes holds gold. And so far, we've been holding gold, I think, for 4 months now at a 10% allocation. Of course, this is dynamic, it's not fixed. So, those strategies that I showed you are much better investment in gold than in just gold itself, because gold itself sometimes doesn't do anything. It has high standard deviation, so huge drawdowns usually associated with that. So it's much better to invest in a tactical asset allocation portfolio than in gold. But also, there is another way, which is to invest in strategies trading gold in and out. You can do it really slow, maybe with seasonality, or of course, you can do it really actively with breakouts and trend following and so on and so forth. So now I'm going to show you some seasonal strategies for gold. So here I have data for the last 54 years. So this covers data since the split between the dollar and gold. And I can show you really easy that there are some patterns, seasonal patterns in gold that happens for this period. So we have a period here in December. You can see this one is a good long period. And then we have another period here is long. And then we have another period here, which is short. Those periods produce profits for the past 54 years. And even in the last 15 years, which is primarily is a bull market for gold, you can see this short period still produce profits. And we can build these strategies really easily. So in StrategyQuant X, you can put this here. So this is one of the patterns, which is 3rd of February all the way to the 22nd of February. This is one of them. And you can adjust these days up and down. They still produce the same amount of profits. And here I have data since 2001. And we can see, so it's almost did nothing for 6 years. And it's been on a good run since then. So this is a long strategy. And here now I show you the difference between those three patterns, the one I just showed you, which are seasonal patterns since the year 2001 till today. So this is on the right is the buy and hold strategy. And we can see we peaked in 2011 almost, and then we just touched it again in 2020, and now we are in a drawdown. And since then, we made about $150,000, and our drawdown was $91,000. And you can see the performance here. So far, we are $100,000 up, but this is our drawdown, $91,000. Now, on the left side, here I have three strategies. So here are the three strategies, which are the three patterns, one in February, one in March, and one in December. So we trade 3 times a year, and we achieved a better return and a better drawdown. So this one has made $175,000 with a maximum of $68,000 drawdown. So compared with this, which is we make 100 and we have 91 in drawdown. And remember, here we are staying, let's say, on average about 2 months per year in the market. And the rest of the year, our cash is sitting somewhere else. So you can put that in bond, or you can put that in other strategies. So there is no optimization, by the way, on this pattern. I just picked these three patterns. I didn't put any filter for volatility or for direction. I just used the pattern as raw pattern. And that is the way to do it as a systematic algo trader, or even as a systematic investor. So either by building strategies targeting gold, and then you have those strategies in your portfolio. So then you are in gold, but you are trading gold when the odds are with you. Or if you cannot trade actively, then you can invest in tactical asset allocation strategies that have gold built in as one of the instruments. And they either traded dynamically or even statically, like Ray Dalio all-weather portfolio. But either way, you get the benefits of gold, and it lessens the drawdown, or when gold does nothing, then another asset is doing something. Both of these methodologies will beat buy and hold by a lot, because in both of them, you will reduce your drawdown, you'll increase your profits, and with actively trading, of course, you can also achieve higher even profits, because remember, your cash is doing nothing for 10 months, which is you can easily invest in other strategies or invest it in another portfolio that invests, let's say, in momentum bonds, which brings, let's say, another 6% per year. To learn more, make sure to watch these videos, and I will see you.